Hello, and welcome to our documentary channel.
In 2023, something happened in the gold market that most people completely missed. Central banks around the world bought more gold than in any year since 1967. Not a little more, not marginally more. The most in over 50 years. According to the World Gold Council, central banks purchased over 1,037 tons of gold in 2022, and then did it again in 2023. 2 consecutive record-breaking years. Now, a single spike could be a coincidence. 2 consecutive record years is a pattern, and patterns in finance are never random. To understand what's happening right now, we need to go back. In 2007 and 2008, before the global financial system nearly collapsed, something quiet was already happening in the gold market. Central banks, the same institutions that had been selling gold throughout the 1990s, went silent. The selling stopped. And then, slowly, the buying began. Gold was trading at around $640 an ounce at the start of 2007. By the peak of the 2008 crisis, it had climbed past $900, and by 2011, after the full scale of the damage became clear, it had reached nearly $1,900 an ounce. The institutions that understood what was coming moved first. Retail investors, ordinary people, found out last. Go back even further, to the Cold War. During the deepest tensions between the United States and the Soviet Union, both sides held gold, stockpiled it, guarded it. Not because they were old-fashioned, because both sides understood a truth that modern finance tries to make us forget. When the rules of this game break down, gold doesn't ask for permission to hold its value. Every time the world has stood at the edge of a major financial or geopolitical rupture, gold has moved first. It's not a prediction, it's a record. To understand why governments are reaching for gold right now, you need to understand what makes it different from everything else in the financial system. Rule 1. No country controls it. The US dollar is controlled by the United States Federal Reserve, the euro by the European Central Bank, the yuan by Beijing. Gold is controlled by no one. It has no issuer, no central authority, no political allegiance. Rule 2. It cannot be printed. When governments need money they have options. They can raise taxes, cut spending, borrow, or they can print. Since 2008, the world's major central banks have created tens of trillions of dollars worth of currency out of thin air. Gold cannot be printed. It cannot be created by a policy decision made at 2 a.m. in a crisis meeting. There are approximately 212,000 tons of gold that have ever been mined in all of human history. That number grows by roughly 1.5% per year. No government, no central bank, no emergency legislation can change that. Rule 3. It is universally recognized. The International Monetary Fund, the institution that acts as the lender of last resort for the entire global economy, holds gold as part of its reserve assets. Not because it's traditional, because in a world where every currency can be inflated, frozen, or weaponized, gold remains the one asset that all parties will accept. Governments don't buy gold because they think it will make them rich. They buy gold because they're afraid of what might happen to everything else. So who exactly is buying? China. China has been the most aggressive accumulator. The People's Bank of China has reported gold purchases for over 18 consecutive months, and analysts believe the disclosed numbers are only part of the story. China has a history of revealing reserve changes in large, sudden announcements rather than gradually, month by month. The goal is transparent even if the timeline isn't. Reduced dependence on the US dollar. Russia's playbook came first, and it was a direct response to geopolitical pressure. After the Crimea sanctions in 2014, Russia began aggressively converting its dollar reserves into gold. By the time the massive 2022 sanctions arrived, Russia's gold reserves had more than doubled. The logic was brutally simple. You can freeze a dollar account. You cannot freeze gold sitting in Moscow. India's case is different, and in some ways more revealing. India is not in geopolitical conflict with the West. It is not under sanctions. It trades freely with the United States. And yet, the Reserve Bank of India has been buying gold at a pace not seen in decades. In 2024, India repatriated over 100 tons of gold from the Bank of England, physically shipped it back to vaults on home soil. When a country brings its gold home, That is not a routine financial transaction. That is a statement. India, China, Russia, Turkey, Poland, Singapore, Czech Republic. The list of central bank buyers reads less like a commodity trade report and more like a map of countries quietly preparing for a world where the rules look different. And at the center of all of this sits one uncomfortable question. What are they moving away from? Since World War II, the United States dollar has been the world's reserve currency. It is the language of oil, of trade, of debt. Roughly 60% of global foreign exchange reserves are held in dollars. If that number falls, even slowly, the consequences ripple through every economy on Earth. And that number has been falling. So what is actually driving this? There are three theories, and the unsettling thing is, they're not mutually exclusive. Theory 1. Currency crisis preparation. The world has never carried this much debt. Global public debt has exceeded $100 trillion. Interest payments alone are consuming larger and larger portions of government budgets. When debt reaches these levels historically, there are only a few exits: growth, inflation, restructuring, or collapse. Inflation erodes debt. It also erodes savings. It also destroys the purchasing power of currencies. Gold is one of the oldest hedges against currency debasement ever known. Central banks know this better than anyone. If you believed, quietly, professionally, that the currency system was under structural strain, this is exactly what you would be doing. Theory 2. Sanctions risk. 2022 changed something permanently in how countries think about financial exposure. When the West froze Russia's foreign exchange reserves, approximately $300 billion overnight, every central bank on Earth received the same message. Dollar reserves can be weaponized. It didn't matter whether you agreed with the sanctions or not. If you held your reserves in another country's currency, in another country's financial system, you were exposed. Gold held domestically cannot be frozen, cannot be seized remotely, cannot be sanctioned. For countries that have any friction with the West, or simply want insurance against future friction, the calculation changed permanently. Theory 3. Dollar de-risking. This is the long game, the slow structural shift that economists debate in quiet rooms. The dollar's dominance is not guaranteed. It was built on trust, military power, trade relationships, and the fact that there was no alternative. But alternatives are forming. BRICS nations are exploring settlement currencies. Trade deals are being signed in yuan, rupees, dirhams. The infrastructure of a parallel financial system is being quietly assembled. Gold is the one asset that sits outside all of it, and inside all of it simultaneously. It is accepted by every side. It has no nationality. In a world that may be fracturing into competing financial blocks, gold is the only truly neutral reserve. Any one of these explanations would be significant. The fact that all three are happening simultaneously is what should make you stop and think. In 2006, everything looked normal. Banks were profitable, markets were up, housing was booming. The people who saw what was coming weren't louder than everyone else. They were quieter, they were moving assets, they were preparing. Not panicking, preparing. The institutions managing the gold reserves of entire nations, staffed by the sharpest economic minds on Earth, with access to data the public never sees, are sending a signal. Not in words, in metal. Maybe it means nothing. Maybe it's prudent diversification. Maybe this is routine portfolio management dressed up to look dramatic. The fact that all three are happening simultaneously is what should make you stop and think. In 2006, everything looked normal. Banks were profitable, markets were up, housing was booming. The people who saw what was coming weren't louder than everyone else. They were quieter, they were moving assets, they were preparing. Not panicking, preparing. The institutions managing the gold reserves of entire nations, staffed by the sharpest economic minds on Earth, with access to data the public never sees, are sending a signal. Not in words, in metal. Maybe it means nothing. Maybe it's prudent diversification. Maybe this is routine portfolio management dressed up to look dramatic. Maybe. But if the institutions that control the global financial system are moving into gold, the question is, what do they see coming that the public doesn't? Thank you for watching. Meet in the next video.